Wouldn't it have been great if you'd bought a ton of Bitcoin before the approval of those ETFs? To have picked some up before the price rallied to near its all-time highs? Well, if you'd been following a few key metrics, you would have been able to sense that something was up before it popped. Today, I'm going to go over some of these metrics, tools, and charts that could have given you the market edge. You don't want to miss this.
Hail Satoshi! I am Gaius Cryptopius of the Legion Coin Bureau. I am many things: warrior, teacher, pioneer, slayer of barbarians and moonboys. But one thing I am not is a financial advisor. That means everything you are about to witness is for educational and entertainment purposes only. Est manifesta? Now, if you wish to join the Legion and fight at my side, then strike that subscribe button with your gladius and ring that little bell too. That way you shall hear the call to arms whenever another video is released. Now, Legionary, let us form up for battle and march forward as one. Onwards!
Quick recap on where we're at. In case you've been living under a rock the past 2 weeks, the SEC recently approved 2 Bitcoin futures ETFs. These were the ones by Valkyrie and ProShares. There are also rumours that more are on the way. So it's no doubt a major milestone for Bitcoin. Ever since 2013, when an application by the Winklevoss twins was met with laughter, Bitcoin ETF applications have been filed. Every single time that there was a new application, crypto news would cover it. Hopes were raised, only to be dashed by the SEC as it declined the applications at the last minute. Now, I recall those days back in 2018-2019 when the notion of a Bitcoin ETF became a bit of a meme. People, including myself, became a bit jaded by it. However, there was renewed optimism this year when we got a change of guard at the SEC. Gary Gensler, a professor who taught blockchain at MIT, was appointed chairman. A flood of new applications came in as a result. Now, although Gary does not appear to have been the crypto savior everyone had wished for, he did communicate what he would require for the SEC to approve a Bitcoin ETF. That was a futures-backed instrument, one that invested in CME Bitcoin futures in order to get exposure to the price of Bitcoin. Now, while this may have been a bit of a letdown for those who had hoped for an actual Bitcoin-backed ETF, it was good to at least get some guidance. With that disclosure from Gary, a raft of futures-backed ETF applications started coming through. Up until about 2 weeks ago, there were up to 20 applications sitting in the SEC's in-tray. There was something different about this time, though. There appeared to be a lot more optimism that these instruments were coming. From rumours circulating in the media to the views of institutions and crypto veterans. And not only that, but more applications were being brought to the fore on a near daily basis. Some people knew more than others. Since the beginning of October, we started seeing a slow and steady ascent in the price of Bitcoin. This was despite the fact that there were no solid sources of news flow or information, only the potential of an ETF. However, if you'd been reading the data, monitoring the charts, and analysing the on-chain stats, you would have sensed that something was on the go. And then, last Friday, we got the news that numerous exchanges were getting ready to list these Bitcoin ETFs. The price shot up quite expectedly, and those that had bought Bitcoin in the days leading up to the release were sitting pretty. Okay, that's all well and good, but it's useless unless you could have spotted it prior to the news. However, if you dug a bit deeper, you would have found all of that which you seek. And one of these treasure troves of hidden information was what was happening on-chain. So, let's take a look at that, shall we? Over the past few weeks, I've been talking about the low levels of Bitcoin held on exchanges. Since July of this year, those balances have continued to fall. Now, low exchange balances mean that Bitcoin is being removed from the exchanges and stored in self-custody or cold wallets. In other words, this is Bitcoin that is not meant for sale anytime soon. I should also note that the bulk of the trading volume taking place on most exchanges is by those who have high-value accounts, i.e. whales. This is something that was recently disclosed in a Coinbase institutional report. I did a video on that, which I'll leave a link to in the description. So what this shows us is that investors were stacking those sats in the months prior to the event. This became even more noticeable when August rolled around and Gary started making his statements about Bitcoin ETFs. Apart from the exchange balances, you could also have studied the movements that were taking place between whale wallets. For example, at the end of September, the number of transactions of $10 million or more was also at a record high. However, given that the exchange balances continued falling, these transactions were not destined for the exchanges. Either whales were moving their funds off of the exchanges or larger OTC purchases and transfers were taking place. And in the week just before the announcement, a Bitcoin whale sent a single transaction of $1.5 billion. Can you imagine how crazy that weight must have been before it hit his wallet? Now, on top of this, we could also have observed what was happening within the whale wallets themselves. Over here, we have the number of wallets that hold over 100 Bitcoin. These are your proverbial whale wallets. As you can see from this chart over on Glassnode, the number of wallets with over 100 Bitcoin has been steadily climbing over the past 2 weeks. According to crypto analytics firm Sentiment, this accumulation of Bitcoin was the largest day of accumulation by whales since July of 2019. So, if you'd been studying what had been going on the blockchain, you could have caught wind of something being up. And if you have no idea how to read these on-chain stats, then there are videos out there that can take you through it. Okay, so that's on-chain metrics. However, there are many investors who may have been gaining exposure to Bitcoin through other means. Although these upcoming ETF instruments are going to open up Bitcoin investing to a whole swathe of investors, there are numerous fund instruments currently on the market. These include the likes of Grayscale's GBTC Trust, exchange-traded products, ETPs, and ETFs issued in other countries. These funds have been attractive alternatives for institutions who would prefer not to hold physical Bitcoin but still want exposure to the price. Anyways, tracking the inflow or outflow of investment dollars into these funds helps give us a sense of whether there is demand for the product. Now, thankfully, the chaps over at CoinShares regularly track these stats and they release a weekly report that breaks these inflows or outflows down. Their most recent report before the announcement was published on the 11th of October, and it showed that inflows into these investment products over the week totaled $226 million. This capped up the 8-week run that they were seeing of over $638 million. It's also pretty clear where these inflows were going. It was the Bitcoin funds. Solana had much more modest inflows, whereas ETH funds actually had a bit of an outflow. On this chart over here, you can see the inflows and outflows to the funds over the past 3 years. As you can see, up until very recently, there was a net outflow. However, it reversed about 2 weeks ago. Now, according to the authors of the report, quote, "We believe the turnaround in sentiment towards Bitcoin is due to constructive statements from SEC Chair Gary Gensler, potentially allowing a Bitcoin ETF in the US." Oh, how prophetic they were. So, what we have is a situation in which the on-chain data was pointing to a whale accumulation and the fund flows were showing a similar accumulation. But there are still other avenues for investors to gain exposure to the Bitcoin price, and that is through the use of futures. Yep, the exact instruments that these ETFs will be based on. So, how were those markets shaping up prior to the announcement? On the futures market, open interest is the total notional value of contracts that are outstanding. And if you track how this open interest evolves over time, you can get a sense of what demand is doing for these respective instruments. So, if the open interest is increasing, one can only assume that investors are increasing their exposure to the Bitcoin futures market, and hence the price of Bitcoin. With that in mind, let's open some open interest charts over on Glassnode. Open interest reached its lowest level for over 9 months on the 26th of September, which you can see over here. However, things took a turn towards the end of September as investors started gaining more exposure to the futures markets. Open interest on all the exchanges went from less than 8 billion to over 13 billion in the span of less than 2 weeks. Now, what's even more interesting than this is the fact that a large proportion of this increase in the open interest during that 2-week period was coming from CME Bitcoin futures. For those who don't know, CME futures are usually the ones that are bought by institutions and other funds. According to this research piece from the folks over at Onchain Research, the growth in CME open interest almost doubled from September the 28th to the 12th of October. The percentage of open interest comprising CME instruments went from 12 to 17% over the period. Not only that, but there's an increase in the basis premium on these CME futures. What this shows is that those that are buying these instruments are bullish on Bitcoin's price performance. Now, according to the research paper, quote, this could indicate that CME traders have a bullish outlook on the ETF decision. Next week could potentially be eventful, as ProShares and Invesco could receive their verdicts. And it's not just conjecture, it's borne out by historical performance. If you take a look at this chart, you can see that previous periods of bullish runs were preceded by these front-month contract premiums. The authors also noted that the CME futures contracts had never traded at this basis premium, with the price being so high. Now, I should of course point out that this basis premium was not exclusively a CME phenomenon. The 3-month annualized basis on futures contracts had climbed across all of the major futures exchanges. It was also at the highest level it had been since May of this year. Now, if we couple this increasing basis with the growing open interest, it shows that leverage to the upside was picking up. Okay, so it seems from data coming from the futures market that something big was afoot. However, it's not the only derivatives market where signals were flashing bull. Over in the Bitcoin options market, sentiment was similarly bullish. Now, for those who don't know, an option is an instrument that gives the holder the right, but not the obligation, to buy or sell an asset. You get call options, which give you the right to buy an asset at some time in the future, at some price in the future. Then you have put options, which do the same, but the option to sell. Ergo, calls are bullish bets and puts are bearish bets. Anywho, much like in the futures market, the open interest in Bitcoin options was skyrocketing from the September lows. Taking a look at data from Glassnode, we can see that the open interest went from just under $6 billion on the 28th of September to over $12 billion on the 15th of October. As is the case with the futures instruments, this shows that these investors were buying a load of options in anticipation of something big. Now, of course, these could be both call and put options, so we want to try and get a sense of how the market was skewed. Well, you can do exactly that by looking at the option skew. Yeah. Basically, the option skew is a measure of the relative price of puts and calls within the same delta, or price sensitivity. This is the exact formula used to calculate the skew. Now, don't be intimidated by it. It's quite simply just a rough measure of the difference in price between puts and calls. By tracking the skew of options over time, you can get a sense as to what the market is demanding. If the skew is decreasing, that means that investors are paying more for calls, bullish, and paying less for downside protection, puts. Okay, so how did the option skew look in the weeks leading up to the futures announcement? Well, it was falling across numerous different expiry dates. This is according to this chart over here. The fall was especially noticeable on the 1-week and 1-month options. It also entered negative territory, which means that investors were willing to pay more for the calls than the puts. According to Luke Streyers, Chief Commercial Officer at Deribit, quote, when the skew moves from over plus 10% in the past month to below 0, it indicates a more bullish overall sentiment. Something else that we can look at in the options market is the open interest in outstanding contracts according to their strike price, the price at which you can buy or sell in the future. Naturally, if there is more call open interest in high strike prices, the market is more bullish. There is a reasonable expectation that the price of Bitcoin would be above those strike prices on expiry. Now here we have the strike price distribution. As you can see, there is a lot of open interest for those options that are above 60k. At the magical 100k level, we have over 12,000 call options being bought. So what all this shows is that there was this similarly bullish sentiment in the options market. Investors were shifting their positions and taking on more upside bets. Now, by the way, if all this option data stuff is foreign to you, don't worry. There is a great video done by a channel called The Coin... Oh wait, that's one of mine. Now, the one final thing that I want to look at is less data and more disclosure. That is because sometimes it's about reading in between the lines of what's being said and done by the big money men. Now, something that I found particularly strange over the past few weeks was that despite all the FUD that was floating around about the infrastructure bill, institutional investors were still lining up. There were a number of banks, asset managers, and funds that were jumping into the crypto markets, and this has picked up pace considerably over the past few weeks. For example, more recently, you had the likes of US Bank, the fifth biggest retail bank in the United States, announcing that it's going to be releasing a Bitcoin custody solution. This would cater to its institutional investors such as fund managers, etc. What's even more interesting is that these funds that were looking for custody solutions were doing so in the anticipation of a Bitcoin ETF. According to the vice chair of the bank's wealth management division, quote, "Some literally want custody contracts signed the day the SEC approves an ETF." Interesting indeed. Over on Wall Street, the banks have been active in increasing their exposure to the space. For example, about a month ago, Citigroup disclosed that it wants to start offering Bitcoin futures to its clients. As we all know, Citi's clients are not investors like you and me. They are large hedge funds and mutual funds that make use of their investment banking and prime brokerage services. Across the street from Citi, you have the likes of Morgan Stanley. These chaps weren't just offering services to their clients, they were also straight up increasing their exposure to Bitcoin. This is because it was disclosed in an SEC filing that MS had doubled its exposure to Grayscale's GBTC fund since April. Essentially, it picked up more than $240 million worth of the shares in the period. Leaving the offices of Morgan Stanley and heading over to Bank of America, we have further evidence that something was afoot. That's because the bank had only recently started its coverage of cryptocurrency. Now, what makes this so damn surprising is that out of most of the Wall Street banks, BOA has been one of the least bullish. In fact, as late as January this year, one of its senior analysts labelled crypto, quote, "the mother of all bubbles." In March, another team at the bank issued a report that was bashing Bitcoin. Some of the same bog-standard FUD that you'll see over on CNN. It's too volatile, it's too slow, it uses too much energy, yada yada yada. So it's pretty crazy that they would decide to immediately start their coverage of crypto only 2 weeks ago. And their first report into the market was labelled, quote, "Digital Assets Primer, only the first inning." Now this was one monumental report at over 170 pages long, but luckily for you folks, I read it so that you don't have to. And not only that, but I have a complete summary of it, and all of which you seek is in the top right. Now, while the report itself was really insightful, it's the rationale as to why BOA made such a 180 on crypto. Could it perhaps have been preempting something and wanting to give its clients a complete 101 guide to these asset classes? Moreover, in one of the appendices, it talks exclusively about Bitcoin ETFs and makes the case about how the success of the Canadian ETFs is further proof of the need for them in the US. Anywho, one more bank that I want to touch on is JP Morgan. Over the past 2 months, the bank has been giving its clients exposure to crypto investment vehicles and funds. Moreover, in early August, it was disclosed that the bank was pitching its private clients a potential in-house Bitcoin fund. And a few weeks before the ETF launch, the bank was making the case for Bitcoin being a better hedge of inflation than gold. Now, of course, the bank's employees were not too convincing to their CEO. That's because literally a few days before the ETF announcements were made, he was back talking smack about Bitcoin. Or maybe that was the plan all along. Maybe these modern-day robber barons knew something big was around the corner, and they were trying to discourage retail investors while still selling Bitcoin products to their clients. Conspiracy? Well, perhaps, but stranger things have happened. And that's it for most of my video, folks. It's time for a few final thoughts. It's true that there is information asymmetry in the crypto markets. Some people knew that a Bitcoin ETF announcement was imminent and invested accordingly. Of course, this information asymmetry is not unique to the crypto markets, and it's an unfair advantage certain groups have had in numerous other asset classes. However, what's unique to crypto is the ability for us to use tools at our disposal to get a feeling for the market. By using blockchain analytics, we can study on-chain movements and see what the whales are doing with their coins. In this case, they were accumulating at a rapid pace. Exchange balances were falling and large transactions were taking place between wallets. If you had been studying the futures market, you would have gotten wind of the bullish sentiment all round. Open interest was on the rise. Basis was climbing fast. The options markets were also positioned to the upside. Investors were making increasingly bullish bets and paying less for downside protection. And then, of course, we had the rapid and suspicious turn from many of these traditional financial powerhouses, banks that had previously written off Bitcoin and castigated crypto. But it just goes to show, study what someone is doing, not what they're saying. Now, while the release of Bitcoin ETFs is a milestone, there is still a long way to go before full mass adoption. The next step will, of course, be spot-backed Bitcoin ETFs, and it's anybody's guess when these will be approved. But if you happen to be monitoring some of the things I've covered in this video, you may potentially have information other market participants are ignoring. And as the great Gordon Gekko once said, the most valuable commodity I know of is information. Now I'm keen to hear from you folks. Did any of you notice these trends ahead of the ETF announcement? Do you have any questions for me? Fire them down into the comments below. And while you're down there, you absolutely have to check out my socials page. This has links to all the other places that you can follow me off the tube. These include the following: my Telegram channel, where I share market analysis and views, Twitter, where I share news and other tips, Instagram and TikTok for behind-the-scenes views and memes, and, of course, my email newsletter, where I share a breakdown of my personal portfolio as well as a breakdown of some upcoming videos. Fancy helping out the channel? Well, check out my merch store. I have some really crazy designs, and all sales go to help keeping this channel ad-free. All of this is, of course, given down below. And finally, if you found this video fine, then fire up the likes. Don't forget to subscribe to make sure you're in line to receive my latest crypto vibes. Oh, and hit that bell as well. We don't want it to get lonely. That's it for today, my fellow crypto fans. This guy's gotta fly.